Hello, my name is Ignacio Orozco and my partner Diego Espinoza. In this PowerPoint, we will take two financial institutions into consideration and compare them. That is Lowe's and Home Depot. Who are our shareholders? Home Depot has 1.5 billion shares outstanding, with 36.1% of the top 10 institutions who own Home Depot. Lowe's Company has a little less shares outstanding compared to Home Depot, with 1.13 billion shares outstanding. The top 10 institutions own 31.3% of Lowe's. The Vanguard Group, Inc., and State Street Global Advisors hold a combined of roughly 145 million shares of Lowe's and 133 million shares of Home Depot. Do they care about our cost of capital? Essentially, the cost of capital determines the riskiness of a company. When investors purchase stock of a company, he or she expects to see return on that investment. If done correctly, cost of capital will maximize the value of the firm, and investors will receive higher returns. What is our cost of debt financing? By taking the sum of the risk-free rate and the default spread, our risk-free rate is 2%, equal to a 10-year T-bill. Lowe's had a default spread of 0.7 and Home Depot spread of 0.4. After making calculations, Lowe's before cost of debt is 2.7 and Home Depot's is 2.4%. After tax cost of debt includes how much the debt costs after tax. It's found by multiplying the pre-tax by the difference in the effective tax rate total interest. Lowe's after-tax cost of debt equals 1.79. Home Depot's after-tax cost of debt equals 1.524. What is our cost of equity financing? The cost of equity financing can be determined by using the CAPM model and also using the regression closing cost of a 5-year monthly compared to the S&P 500. We calculated both companies' beta. Lowe's beta equals 0.8 and Home Depot's beta 0.95. What is our overall cost of capital? By looking at our diagram, we were able to calculate the weighted average cost of capital, or in other words, the WACC. Lowe's WACC equaled 6.27% and Home Depot's WACC equaled 6.53%. Could we lower this by changing our capital structure? Both companies' optimal debt ratio equaled 0%. Therefore, the analysis suggests both Lowe's and Home Depot should not take on more debt. How would a financial restructuring after the value of our company be affected? Both Lowe's and Home Depot's are sitting in the same boat when it comes to lowering their capital structure. Both companies would lose value according to the table from the previous slide. Would more debt create unnecessary risk? Yes, debt causes higher risk. More debt equals more interest payment. Higher debt translates to higher cash flows to stay afloat. What does the competition do? Compared with the competitors, Lowe's has less cash and current assets compared to the other three companies. Is our stock price fairly valued? After analyzing both Lowe's and Home Depot's stock is currently good, according to the optimal table value in this analysis.